Hello and welcome to this wealthmanagement.com fast chat. I'm your host, Shannon Rossick. Well, market volatility is back in focus. And as uncertainty rises, investors are looking for ways to manage risk, generate income, and ultimately enhance portfolio returns. And one strategy that's gaining traction: covered call writing. So today I'm joined by Barry Martin, portfolio manager at Shelton Capital Management, to discuss how covered calls can provide a valuable third slice to the traditional 60/40 portfolio, how they perform across different market conditions, and what investors need to know about their risks and rewards. Barry, let's dive right in.
Thanks, Shannon. Good to be here.
Absolutely. So earlier this week, we're obviously in March, the CBOE Volatility Index, VIX, closed at its highest in nearly 3 months. With the NCAA March Madness tournament around the corner, we have seen our own market madness, if you will. Love that. The recent uncertainty and increased volatility in the markets has heightened the need for effective risk management tools. So unpack this for us. Talk through the evolution and proliferation of option-based strategies and why they make sense for today's market conditions.
Yeah, I've been doing this for over 25 years now. And when this started, it used to be like a niche product where institutional investors would use options to really hedge risk and generate additional premiums and cash flow. But ever since the financial crisis, this has actually moved on to where advisors started to use it, and we've gone all the way down to the retail side. Since 2020, this category has raised, I have the number right here, $220 billion. So it's been amazing. And I think a lot of it has to do with a couple things, mainly, I believe, demographics. So Wall Street Journal did an article last year, and they called these type of strategies boomer candy. And it kind of makes sense. It's a different slice of the pie, right? So what you're doing is typically you have equities for growth and you have bonds for safety. This is kind of in between. So you get a little growth with a little safety as well. So what the option premiums do is, like, I'm not necessarily trading volatility. I'm just using it as an asset to really risk mitigate and basically have people stay in the game but able to sleep at night.
And today, more sophisticated investors are really seeking adequate diversification through alternatives and reliable income streams and cash flow generation. And really, to simply put it, the 60/40 balanced portfolio that worked in the past just cannot keep up with the rapidly evolving market environment. So if you wouldn't mind, just describe how covered call investing can provide, like you said, that third slice to the traditional 60/40 allocation, and how are clients thinking about integrating derivative income solutions into their portfolios?
Yeah, so I think in the past, like with your typical 60/40 portfolio, you had correlations that became positive. So people are looking for an alternative to reduce that positive correlation and look for diversification. So that's why this type of product has been added to a 60/40 portfolio. So we're typically seeing people take maybe 10% of fixed income and 10% of equity and creating a new slice of pie. So we're starting to see more of the 50/30/20 portfolio. The CBOE recently came out with a white paper, and they said a 50/30/20 slice with the derivative income added to the one's portfolio has actually outperformed the 60/40 portfolio 14 out of the last 19 years with a superior Sharpe ratio. And that makes sense because, once again, it's kind of like it basically acts in between. So you have the derivative income, typically equity standard deviations around 13 compared to the market. But these type of products are generating between 6 to 9% in income. So it's kind of it's a new way to look at things, and I think that's why you've seen the popularity of this category jump up so much.
Well, it makes sense. And I know we talked a little bit how covered call writing works with elevated volatility, but can it work in all markets, whether it's down, flat, or up?
Yeah, so it really does. So this really works well in a choppy sideways market with a little bit elevated volatility. So those cash premiums are the drivers of the return when it goes sideways. If the market moves down, those premiums then act kind of as a buffer, as a hedge. So it adds a little bit of safety to your portfolio. And if the markets appreciate, your upside is capped, but you will see some appreciation from the underlying equities. So it really works in all different types of markets. It's a very nimble strategy. But the real downside, I think, is more of an opportunity cost. When the market takes off, you won't see that dramatic appreciation. But if you're looking at the 50-30-20 split, your 50% of the portfolio will see that dramatic appreciation. So it works really well in all types of markets.
I love that, sideways and choppy, but let's get into the weeds a little bit here. How are you selecting stocks to include in the portfolio, and how do you determine the call price to write on top of these equity holdings?
Yeah, so typically we're only investing in the S&P 500 equities, but you obviously can sell covered calls on anything. What we like to do is look at more of a conservative approach to writing covered calls and look at conservative defensive quality names, names that generate free cash flow. So historically, well, basically how I look at things, when we write a covered call, your upside's capped and you have a lot of downside risk. So we try and manage that downside risk as much as possible. And I recommend people do that the same way. Because when you're selling covered calls, you're capped on the upside. So we're not big believers in buying high volatile names that have a tremendous upside to sell covered calls on. You're buying those for growth. So why sell covered calls on that? It's kind of like hedging a lottery ticket. So we look for more defensive quality names, market leaders, stocks that generate free cash flow. So to use an analogy, if the speed limit's 65, I'm going 50 miles an hour trying to avoid potholes. So those are the type of equities that we buy. In regards to the options that we sell, we're more of a target cash flow kind of selling. So we'll sell a certain amount of options to hit our target of 6 to 9% annually. We don't get too aggressive and too greedy in taking away as much option premium as possible. And also, if periods like this where the VIX is elevated, we'll sell further out of the money. So if we do get a bounce of the market, we'll see some appreciation of our underlying equity.
And we've talked about the upside, but what are the inherent risks associated with covered calls, and how do you ultimately educate your clients?
Yeah, I think the main risk is that you got to remember you still have equity exposure. So you're buying Apple, Microsoft, Amazon, and even conservative names like AT&T, and you're selling covered calls on them. So if the market moves down 10%, your equities will likely move down 10% as well. But when you're selling covered calls, you'll offset that by maybe 1, 2, or 3, or 4%. So you'll be down, but just not as much. But you'll still be down. You have that equity exposure. And as I mentioned earlier, another risk is more of an opportunity cost. So if the market moves up dramatically, you won't see all that appreciation. So right now in our mutual fund, our beta is around 75. And so that's kind of a good feel of how it does compared to a market. So the market's up 10%, will likely be up 7.5%. The market's down 10%, will be likely down about 7.5%. So that's kind of, and I think that the key is the education to the client. And once they know how it performs versus the market, I think that's the big benefit of just the knowledge base of what options do, how they can protect some of the downside, but also limit some of the upside.
Well, this information should certainly quell some fears then in this volatile market. So Barry, thank you for your insights as always.
Thank you.